Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Lumen stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Lumen is a telecommunications company. It is one of the largest providers to global enterprise customers. Its communication services include local and long-distance voice, broadband, Ethernet, video, and network. It has clients in more than 60 countries. The company is headquartered in Monroe, Louisiana, and was founded in 1930. The ticker trades on the New York Stock Exchange, Mexican Bolsa, Deutsche Börse, Sao Paulo, and London Stock Exchange. Let's get started with the model. This is a mid-cap company, 2.6 billion market cap. They're trading at $2.57 a share, and they have 1 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So they all cash flow positive. They had over $3 billion in 2019, a little under $3 billion in 2020, well over $3 billion in 2021, but under $2 billion in 2022. Net income is the profit or loss on the income statement. It's revenue minus expenses. And they have lots of write-downs, so they have negative net income in 3 of the 4 years. Revenue is the sales for the company, and that's why there's always a big sell-off on this stock, because their revenue goes down year after year. It's still a good number. 17 billion is a lot of revenue, but it is declining. This is the company's income statement. The top line is the revenue, the sales. 2022 was 17.5 billion. Let's dig into that number so we understand what it is. Here's a breakdown of their revenue from their 10K. This is 2020, 2021, and 2022. You can see it pretty much goes down in every segment. Their business customers are their bread and butter. That was 13 billion in 2022. International business is 3.6 billion. Large enterprise customers 3.4 billion. Mid-market 2.5 billion, and wholesale 3.5 billion. Consumer business is 4.5 billion, and that's down from 5.9 billion. Below revenue is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, and that goes down each year from 12 billion to 9.6 billion. Below that is their operating expenses. These are all the expenses not directly related to generating the revenue. Gross profit minus operating expenses gives you your operating income. It is lower than prior years, but it's not that much lower than 2019 and 2020, so it looks like they're improving their margins. They spend 1.3 billion of interest on their debt. They do have a lot of debt. Other income and expenses, these are all the gains or losses not part of the company's core operations. They pass through lots of write-downs, 3 billion in 2022. That's why they usually have negative net income each year, because of the asset impairments. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. You can think of operating cash flow as net income converted to cash, because net income is your accounting profit or loss. It's not actual cash. So they are cash flow positive, which is really good. But they do spend a decent amount in CapEx, about 3 billion a year. Operating cash flow minus CapEx gives you your free cash flow. Free cash flow is the cash that's remaining for you, the investor. So that's why they did pay a really nice dividend in the past, but they cut their dividend down to 0. So that really turned off a lot of investors, and there was a big stock sell-off. That's why the stock price got so low. They cut their dividend because they're trying to pay down debt. They paid down 8 billion in 2022. I think once they decrease their debt a little more, they could bring back the dividend payment. They also buy back stock. They bought back 1 billion in 2021, 200 million in 2022. When a company buys back its own stock, that decreases the shares outstanding and makes your shares more valuable. Let's look at the capital structure. They have 10 billion of equity, 21 billion of debt. They're 1/3 equity, 2/3 debt. Their net debt is 20 billion. Net debt is debt minus cash. And I gave them the middle whack on Finbox, 10.5%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 8.3 billion. We discounted those numbers back to today using the weighted average cost of capital, and we get a value of the company of $10 billion. We divide that by 1 billion shares. And we get a calculated stock price of $10. They're trading at $2.57, so they're trading at a 74% discount. It's a really strong buy according to the model. Their revenue forecast for 2025 is $14 billion. For 2024, it's $14.2 billion, and for 2023, it's $14.7 billion. I continued this trend into 2026, and I got $13.8 billion. That's how I got their future revenue estimates. In order to calculate their future free cash flows, I need to see what percent of their revenue they convert to free cash flow. And they converted 10% of their revenue into free cash flow in 2022. It was higher in prior years, but I used the 10% to be more conservative in my model. So I multiplied their future revenue estimates by 10%. That's how I got their future free cash flows. And I assumed their free cash flow would decline 5% in perpetuity. That's how I got their terminal value. Even trying to be as conservative as possible, it still seems like the stock is really undervalued. It's just most people aren't willing to pay this much for the company stock. They are willing to pay $2.57 though. It's interesting to see how close my valuation is to Simply Wall Street. Usually Simply Wall Street is way higher than me. 10 analysts priced this stock and the average price target is $3.81, the low is $2.50, the high is $5. This is where the stock has been trading the last 5 years. It was well over $20 back in 2018, beginning of 2019. And then it dropped below 10 in mid-2019, and it's been hovering around that point for the next year and a half. Then in the second half of 2022, when the company announced a dividend cut, it really came down. It was a huge sell-off. Their stock moves with the market. They have a beta close to 1. It's down 78% in the past 52 weeks, while the S&P is down 14%. The 52-week low is 237. The high is 1254, and the stock is trading well below its 50-day and 200-day moving average. Lots of activity on this stock. Over 50 million shares are traded each day. Almost all the shares outstanding are on float. 83% are held by institutions, and it has a really high short percentage. Over 18% of the shares are shorted. They were paying a really sweet dividend for a long time, over 10%, but then they cut it to 0, and the forecast is for the yield to stay to 0, probably indefinitely. They've done 5 stock splits, all in the 80s and 90s. 3 for 2 in 88, 89, 93, 98, and 99. If you put $10,000 into this company 10 years ago and reinvested the dividends, you'd be really unhappy. You'd be at $1,600 today. That's an 84% total loss. There's been insider buying and selling, although the sells are much bigger than the buys. There's a sell for 5 million shares, 15 million shares, and 2.9 million shares. Temasek is a Singaporean holding company, and that company is controlled by the government of Singapore. 82% of the company is held by institutions, 16% by the general public, and 1.7% by insiders. Their employee count peaked in 2018 at about 50,000, but it's been going down each year since then. They currently sit at 29,000. Their biggest shareholder is Vanguard at 11.5%, then BlackRock, State Street, Southeastern Asset Management, and Invesco. The best way to look at ratios to compare them to companies in the same industry. There are 50 companies in the same industry as Lumen, and Lumen ranks 20th in market cap. If they have a number in red, they're worse than the average. If they have a number in blue, they're better than the average. They spend more than average in CapEx. They're more leveraged than the average company. For every dollar of equity, they have $2 of debt. They do not pay a dividend anymore. They generate more free cash flow than average. They rank 20th in market cap. They have a price to book and price sales of a company about to enter bankruptcy. Right before a company goes into bankruptcy, they usually have a really, really low price of sales and PE. We can't look at their PE since it's negative. Their price to free cash flow is really low, but it's not below 1, so maybe they're not heading to bankruptcy just yet. They generate a lot of revenue, $17 billion, a lot more than the 7 or 8 companies above them, but they're a declining company. They're declining their revenue. The 7 or 8 companies above them are increasing their revenue, and they have a negative ROA and ROE since they have negative net income. To summarize, I have them trading at a 74% discount, but this stock is a real risk. If you like gambling, you may get really lucky in a stock at 2, 3, 4, 5x, but for a long-term hold, I don't think it's the right move. The dividend may come back, but it may not come back. This company is like a falling knife. You could get lucky and cash the knife, but you're more likely to get cut up. I ranked their free cash flows 4 out of 10, their revenue 4 out of 10, and their ratio 6 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.